Hello students and learners, you are welcome back to this session. In today's video, we are going to look at past question from University of Professional Studies located in Accra, Ghana. So if you are new on this channel, kindly make sure to subscribe, like and share. And that's Introduction to Business Finance. So let's move on in that case. Okay, so this is our first question. Session A. You have a cash of 150,000. If a bank offers 4 different compounding methods for interest, which method would you choose to maximize the value of 150,000 Ghana cedis? Okay, so in this case, you realize that with the time value of money, we said the value of money, the present value of money now is more than the still sum of money to receive in the future. We also learned that they are all in the description of this video, the link are there. We also learned that for us to maximize the value of money now, it also not depends on just the time and the interest, but then also the compounding, the rate at which you compound. We said the higher the compounding, the higher the value of that money now is maximized. Okay, so if we are given 4 different compounding, 4 different compounding methods for the interest, we are given daily, quarterly, semi-annually, and annual. That's what the question has been told. So let's say this is our principal, which is what 150,000 as the present value now, and then let's say the time that we were giving is, let's say, 1 year. Is that okay? And let's say the rate is, let's say, 10%. 10%. Is that okay? Good. So we are compounding period that end, because we are giving different compounding period. If for 1 year, going to 1. Is that okay? If for compounded semi-annual, is going to go 2. If compounded quarter is going to go 4. If it's daily, going to go 365. So any of them will what? When you compound, after you're going to get whatever you want to get at the end of the day. So we said the higher you compound, the higher your value, present value of money now is going to be maximized in the future. So all things being equal, you realize that if you are to compound it daily, then we are going to earn much more what? Value. Our value for 1 is going to be maximize in the future. Is that okay? So at any time, the higher the compounding period, the higher our present value of money now is maximized in the future. So that is the concept. So you can even try and compound. So let's say this compounded for annually. So NA is going to what? 1. Compounded for semi-annual, X is going to what? 2. Compounded for quarterly, NQ is going to what? 4. Then compounded for daily is going to what? 365 days. So in all, when we calculate the compounding period, or when you want to maximize the value using the compounding period of 365 days, you expect that you're going to maximize more value than using quarterly, semi-annually, and what? Annually. You can try. This is the formula. Our future value is going to be the present value multiplied by the future value factor, which is 1 plus your interest divided by your n, and then raised to the power and multiply by what? The time factor. So you can use these parameters to check and verify yourself. You can clearly see that the compounding period, if it is increased, in this case, if you have to use this slide, use an increase in value, an increase in compounding period, sorry, is going to maximize the 150,000 you're going to receive for a particular period of time to come. So that is the power of the compounding period. The higher the compounding period, the higher the value of your money now is going to maximize in the future. Okay, so it's not based on only the interest and the time, but how the compounding method is also done also affects the value of money that you have now in the future. So let's take, so here the answer is going to compound what? Daily. Compound daily. So let's take note of that, and this is the formula. You can use them and work it out. Let's go to question number 2. In financial statement analysis, shareholders focus will be on the A, liquidity of the firm, B, long-term, so liquidity of the firm is 1, that's A, then B, long-term cash flow of the firm, then C, profitability and long-term health of the firm, and then D, return on investment. So which of them we think is going to be the prime focus of shareholders? So we said shareholders are basically the owners of what? The company. Okay, so in shareholders we have two types. You have what? Preference shareholders, you have what? Ordinary shareholders. They are all shareholders. They own part of the company. Is that okay? So for shareholders, their prime focus is on first on the profitability of the firm and also how well the firm can last longer. So if a firm is lasting longer, it means that the health of the firm or the financial health of the firm is going to be prolonged. So for them, they look at the profitability and the long-term firm. I mean the long-term health of what? Of the firm. So that is the most priority goal of what? Shareholders. That's what they focus when it comes to financial statement analysis. When it comes to liquidity, liquidity has to do with where we're able to convert assets of let's say assets that are not easily sold. We're able to convert it into what? Cash quickly. That's liquidity. But then their prime focus not on liquidity. Neither the long-term cash flow of the firm. Is that okay? Neither return on investment only, but for them, they are looking at the profitability and long-term health. For the as and when the business progresses and they have that long-term health, they have that healthy financial position, then I mean their financial position in terms of how the company is being structured, then that one is better. That will going to lead them to much more profitability in the future, even now and then what in the future. So for them, they look at the profitability and the long-term health of the firm. So let's take note of that. So if you're really enjoying this video, make sure to hit the like button, and then if you haven't subscribed to the channel, subscribe, and then we all learn alongside. Thank you. Let's move on. Question 3. A group of assets such as stocks and bonds held by an investor is, so here, which of them satisfy the question? A group of assets such as stocks and bonds held by an investor. A, portfolio. B, capital structure. B, budget. D, none of the above. So which of them? You're talking about a group of assets of stocks and bonds held by investors. So if it's a group of assets of stocks and bonds held by an investor, then the ultimate answer should be what? A portfolio. So with portfolio, we are talking about what? A combination of what? Or a blending of what? Various what? Financial securities by an investor with in mind that you want to what? Make more what? Returns, and also to diversify what? Risk. But when it comes to investment, these key factors are very fundamental. Risk and returns. They are very fundamental. So with portfolio as an investor, when an investor held a group of what? Securities in the form of stocks and bonds, and you want to invest, the goal here is that if he's holding that blended stocks, is combining these stocks, and you want to make an investment with it, then the goal here is that you want to make much more better returns and also to diversify what? Risk. Diversification here means what? Diversification here means it's trying to what? To reduce what is its risk. Or every investor seeks to maximize returns and what? Reduce what? Risk. So if you diversify risk, meaning that you want to reduce what? Risk, the rate at which you are going to incur risk in the investment what? Process. So that is portfolio. With capital structure, we're talking about the combination, a mixture of what? Long-term debt and equity that the business used to finance the operation of the business. So we are talking about equity and what? Debt. Equity and debt that business used to finance the operation. And budget, we are talking about statement or plan of action to be pursued in the future. So none of these has a relation to stocks and then bonds. So the ultimate answer is what? A portfolio. We're talking about a blended or combination of stocks that is being held by an investor in an investment what? Process. So let's take note of that. So that's portfolio. Question 4. Anne is interested in purchasing Ted's factory. Since Anne is a poor negotiator, she hires Mary to negotiate the purchase price. So we have Anne here and we have what? Mary here. Identify the parties to this transaction from the given option, keeping in view the agency theory. The agency theory here says that we have three parties. We have the principal, we have the agent, and we have the third party. And then the agent acts on behalf of the principal in dealing with what? Business or transaction. So always the principal has entrusted his power and authority on behalf of he has entrusted his power and authority into the agent, and the agent the activities that the principal should have do if he was in that position. So he acted on behalf of the principal. The agent acted on behalf of the principal in dealing with the third party. So since we said in the scenario here, Anne is a poor negotiator, so he hired Mary. So Mary becomes what, an agent, and Anne becomes what, the principal. Is that okay? And Mary is going to deal with the third party, who is what, third what, factory. So let's take note of that. So in this case, let's see. So we said Anne is a principal and Mary is what, the agent. So A is okay, but let's continue with B. Mary is principal. No, Mary is not principal, so that's out. Third is an a no. So Mary is principal and third is an no. So meaning that A satisfies our goal. So in this case, Anne is the principal and Mary is what, the agent. And third party, or third, is the third party, the third what, party. So here Anne is a principal and Mary is what, an agent. So that is simple. So that is an agent theory. We are talking about three parties in which one party has entrusted its power and its authority to another, called an agent, to act on the principal behalf with the what, the third party. So the agent always deal with the third party on behalf of the principal. Is that okay? So because the principal has entrusted all his power, authorities, and everything into the agent. So let's take note of that. So in this case, Anne is a principal, Mary is an agent, and third party is the third party. So let's take note of that. So question 5. Ratios look at the relationship between individual values and relate them to how a company A has performed in the past, might perform in the future, both A and B, none of the given options. Let's read again. Ratios look at the relationships between individual values and relate them to how a company A has performed in the past, might perform in the future, both A and B, and none of the given options. So here, when it comes to ratios analysis, there's what we call standard of comparison. Standard of comparison look into account the past performance of the company, the past. They also look at the present. They also look at the future. So these are the fundamental key standards that when it comes to ratio analysis, the company looks at. They look at their past performance, the present, and then the future. And they even go on to look at the industrial standard, the industrial level, where the company is located, the industry within which the company is located. It also help them to make what comparison, to know whether they are performing or not. So in this case, it's going to be in the past, future, present, and other. So here, what we were presented was past and then future. So it's going to be both what A and what B. So let's take note of that. So with that, ratios helps companies to identify the strengths and weaknesses of the business through the statement of the financial position and the statement of the income. So that is the whole issue. When it comes to ratio analysis, companies try to make effective analysis from the statement of their financial position and the statement of the income to know whether they are performing well or not. And the ultimate goal is to identify the strengths and weaknesses within their organization in relation to other competitors, in relation to time period, in relation to other factors. Okay, so let's take note of that. So it is both A and B, past, future, and even present, and industrial levels also play another role. So let's move on to question 6. That's a short-term temporal investment that can be readily converted into cash. So what are they? A, marketable securities. B, cash equivalent. C, treasury bills. D, all of the given options. That are short-term temporal investments that can be readily converted into cash. So here, treasury bills last for almost about 91 days. It's a short-term investment. Cash equivalents like promissory notes, bill of exchange, all these things are what? Short-term, more like temporal what? Investment. They can also readily convert it to what? Cash quickly. And marketable securities to a security that we can easily sold, easily sold, and some of them can easily what? Converted to what? Cash. Not all marketable securities can be easily converted to cash, but some of them can be easily converted into what? Cash. So here, the marketable securities here, sorry, we are talking about the one that can be easily converted into what? Cash quickly. So here, all the given options are true. So it's going to be what? All the given options. So let's take note of that. Now let's move on to question 7. If we deposit 5,000 today in an account paying 10%, how long does it take to grow to 10,000? So here we have deposited what? He's saying that if we deposit 5,000 today in an account paying 10%, that's the rate. So here is what? The principal, the present value or the principal. And then 10%, that's an interest, right? They are asking us how long does it take to grow to 10,000. So the 10,000 becomes what? The future what? Value of this invest. So in this case, you apply our formula. Our future value is going to be the present value multiplied by the future value factor, which is going to be 1 plus the interest rate divided by, so future value is going to be present value multiplied by the future value factor, which is 1 plus the interest divided by the compounding period, and all raised to the power of the compounding period multiplied by what? The time. Is that okay? So here, that's the whole thing that we are looking at. How long does it take to grow to this sum? So you represent them, let's represent them, all of them as what? X. Is that okay? So that we know what to do. So in this case, I know my future value is what? 10,000. So here, what are we asked for? We are asked to find what? How long does it take to? So we are talking about what? The time it takes to what? Grow to this amount, 10,000. So here, because the account is paying 10% and it didn't make an indication of the compounding period, the idea is that we are taking the compounding period to be what? Annually. So 1 year. So 1 is going to be 1. So it's going to be 10,000. It's going to be 5,000. Okay. In bracket 1 plus 10%. 10% divided by what? 1. Is that okay? And then all to the power of what? X. So the X represents the duration, the number of duration in this case. So here, what are we supposed? We are supposed to find X. So we divide both sides by what? Let's divide both sides by 5,000. So in this case, we can say that, let me bring it here. You can say that you're going to have here to be 2 is going to be bracket 1 plus 0.1 all to the power of x. So here we're going to apply our basic mathematics here, which is what? Logarithm. So we add log on both sides of the equation. So it's going to be log 2. It's going to be log. So 1 plus 0.1 is going to be 1 point what? 1. Is that okay? All to the power of. So in this case, it's going to be, when you take log of, they're going to be what? Let me bring it here. It's going to be log 2 is going to be, so the x is going to come in front of the log, so it's going to be x log 1.1. So we divide both sides by log 1.1, divide both sides by log 1.1. Is that okay? So therefore I can say that my x is going to be, so with the help of my calculator, I need to get, so with the help of my calculator, I have x to be 7.2725. So in this case, though for time should be absolute value, but in this case, by the option we're giving 2 decimal places, so I'm going to convert to 2 decimals. So we're going to 7.27 years. So meaning that C will satisfy our answer in that case. Option C will satisfy our answer in that case. So that is for question 7. So here we were given the present value, we were given the future value, and they were given the interest payment, right? So in this case, and if you could remember in my previous video, the links are in the description section, we said that if it is compounded annually, we can say that therefore our future value should be equal to the present value multiplied by 1 plus the interest. Is that okay? Divided by the n, or better still, you even bring the division, just the interest all to the power of what? N. Because at the end of the day, it is compounded as what? annual, that's 1. So the time in number multiplied by 1 is going to be what? The same as that number, with the exception of for 0. So you can use this formula straight away. And that's why I replace with what? X. So the x becomes a factor x. So let's take note of that. So let's move on to question 8. Question 8. Question 8. Question 8. You can determine the number of periods in present value calculation if you know. You can determine the number of periods. Now, the number of periods mean we are talking about the compounding periods and I think even the time. That the two will work together in this case. That's the n in this case. So you can determine. So let's write the formula. I think that one is going to help. Feature value is going to be our present value into bracket the feature value factor, which is I divided by n, or raised to the power n multiplied by t. So we are saying that we can determine the number of periods in the present value calculation if you know one feature value is part, two the present value is also part, to the interest rate, because without these factors that I've taken, you can't find the number of periods. So it means that all the options, all the given options above will satisfy. So the answer is what? D. So let's take note of that. Now let's move on to question 9. The present value of a sum of 100 Ghana cedi to be received in future would be. Please pay attention here. It said the present value. You're talking about a PV, all right, of a sum of 100 Ghana cedi to be received in the future. We are talking about. So here, this 100 Ghana cedi here is what the future value. You are saying the present value of the sum of future value of 100 Ghana cedi to be received in the future will be A, more than 100 Ghana cedis, B equals to 100 Ghana cedis, C less than 100 Ghana cedis, D none of the given option. So what do you think? We said to find the future value is going to be the present value multiplied by the future value factor, for which you know. Is that okay? So if that is the case, then if I want to find my present value, is going to what? My future value factor divided by, and I will divide my future value factor on both sides. So I will divide my future value factor with the future value. So it's going to be future value factor here. So meaning that all things being equal, your future value is going to be lesser than your present value is going to be less than your future value factor. Because here we are discounting the future values or future cash flows into present terms. So at any time we discount future cash flows into present terms, if present value is less than the future value. In other words, the future value becomes greater than the present value. So at any time we discount from future cash flow to present terms, the present value is less than the future cash flow. So let's take, so you can even give a trial. You can pick these values. So these are future value, right? Which is what? 100 Ghana cedis. Okay. And let's say, let the rate be, let's say 10%. And let's say, let your time be, let's say 1 year. Is that okay? And it's compounded what? Annually. So n is equal to what? 1. You can use this information. If you like, try. Sorry. 1. You can try with this information. Okay. You see that the present value is going to be lesser than the future value in that case. So here is going to be less than 100 Ghana cedis. So let's take note of that. Let's take note of that. Now let's move on to our last question set for. Now let's move on to our last set of questions for this video. Question 10. Time value of money is an important finance concept because 1. It takes into account risk. It takes risk into account. B. It takes time into account. C. It takes compounding interest into account. D. All the given options. If you remember, when we were discussing the concept of time value of money, we said there are 3 key factors that are pivotal in time value of money calculations or time value of money scenarios. We said one is the return associated with the risk. We talk about time and also talk about what? The returns. We are talking about the compounding interest here. And we talk about the time. We also talk about what? The risk, if you remember. So we spoke about all these key factors that are pivotal in time value of money or calculations. So return, time, so risk and return or time factor. So you can see that you have risk here, you have time here, you have what? The interest, which is what? The returns. So all the options are true for time value of money calculations, or they are true important concepts in time value of money in finance. So let's take note of. So please, if this video was really helpful to you, please go ahead to hit the subscription button. Okay, subscribe and make sure to like this video. Okay, please like and like it. This is what I want expecting from you. Okay, so that YouTube can also push the video to other students also to learn alongside you. Please, I beg you, make sure to like this video and subscribe to the channel and even share with your friends. I really beg you. Thank you for watching. So I will see you in the next video where we continue with MCQ that we have started on the past questions. And this past question is from University of Professional Studies, Accra, Ghana. Thank you. So I'll see you. Bye bye.